traditional tax prep. This is Green Lights, the Physician's Tax Show, unlocking the legislative incentives of the tax code.
Welcome to episode 3 of Green Lights. In our last episode, we broke down the 12-hour Per Diem Secret and showed you how to unlock flat rate, paperless travel deductions for your long clinical shifts. Today we are staying on the topic of food and hospitality, but shifting focus directly to your day-to-day operations. Specifically, the business meals and entertainment expenses that most generalist CPAs completely misclassify. If you are a private practice owner or an independent physician consulting with various clinics, you likely spend substantial capital dining with prospective partners, clinical colleagues, and your administrative team. And if you are like most doctors, you've probably been told by a traditional reactive accountant, just throw all your restaurant receipts into a bucket, it's all a flat 50% write-off, and you can deduct your golf games or whatever if you talk about business. That advice is outdated, incorrect, and it is costing you thousands of dollars in lost tax savings while putting you directly in the IRS crosshairs. Today, we are going to run the offensive playbook to help you legally maximize your meal write-offs up to 100% while completely eliminating audit-triggering entertainment mistakes. Let's look at the actual tax law. Ever since the Tax Cuts and Jobs Act, the IRS completely rewrote the rules for business hospitality under Section 274 of the Internal Revenue Code. First, let's address the most critical red light. Entertainment is dead. Under IRC 274A1, all deductions for entertainment, amusement, or recreation are strictly limited to 0%. This means those courtside basketball tickets, concerts, golf outings, or country club memberships are completely non-deductible, even if you discuss a multi-million-dollar clinical partnership during the event. If your accountant is still writing these off, they are flashing a yellow or red light to the IRS. However, business meals survived, but the law created a strict partition. Under 274N1, ordinary and necessary meals with clients, referral sources, or professional colleagues are capped at a 50% deduction. Furthermore, to claim this safely, the physician or an employee must be present and the meal cannot be lavish or extravagant under the circumstances. But here is the green light. Congress carved out highly lucrative exceptions under 274E that unlock a 100% fully deductible operating expense for food and beverage. If you host employee recreational activities like company holiday parties, employee appreciation dinners, or summer picnics, primarily benefiting your non-highly compensated staff, those expenses are completely exempt from the 50% limit. They are 100% deductible. But be very careful. Starting January 1st, 2026, a major tax cliff went into effect. Meals provided for the employer's convenience, like ordering late-night shift delivery for your on-call doctors or stocking the break room with free snacks, have officially dropped from 50% down to 0% deductibility. They are now completely non-deductible. The trick is separating your clinical, operational dining from your business development client dining and documenting them accordingly. Let's run the math to see how proper entity categorization impacts your bottom line. Under the slide formula, we calculate tax savings as tax savings equals deductible expense amount times marginal tax rate. Suppose you run a private medical clinic and spend a total of $10,000 per year on food, staff lunches, and business dining. Let's say a non-specialized CPA lazily dumps all $10,000 into a single meals category. The IRS automatically caps your deduction at 50%. Let's calculate that basic deduction. $10,000 times 50% equals $5,000 deductible. For a high-earning practice owner in the federal 37% marginal tax bracket, that basic deduction yield $5,000 times 37% equals $1,850 in actual tax savings. Now let's run the optimized offensive playbook. By analyzing your calendar logs, we identify that $8,000 of that spending was actually used to host structured employee appreciation events, holiday celebrations, and staff team building dinners. only $2,000 was spent on traditional client or colleague dinners. By segregating these expenses into separate ledger accounts, your optimized deduction becomes optimized deduction equals $8,000 times 100% plus $2,000 times 50% equals $8,000 plus $1,000 equals $9,000 deductible. Now let's calculate your cash in pocket tax savings at that same 37% marginal tax rate. $9,000 times 37% equals $3,330 in optimized tax savings. By simply separating employee operational appreciation meals from client dinners, you legally secure $3,330 minus $1,850 equals $1,480 in extra annual cash. That is nearly $1,500 in pure tax-free cash kept inside your medical practice, completely legally, just by changing how you label your expenses. To claim these deductions safely, substantiation is everything. The IRS requires you to document the 5 W's for every meal. Who was there? What was the business relationship? When did it take place? Where did it happen? And why was the business discussion necessary? For business gifts, remember the tax code limit is strictly $25 per recipient per year under 274B. And if you are hosting promotional events for the public, document the guest list. Those public-facing meals are 100% deductible. Stop playing defense. Not documenting properly can cost you thousands in legitimate staff operating deductions. And stop risking audits with non-deductible entertainment write-offs. To draft your personalized, proactive tax blueprint, visit us at Physician Tax Solutions and schedule your strategic consult today. Again, this is Jeff from Physician Tax Solutions. Keep the lights green and see you next episode.
The information provided in green lights, the Physician's Tax Show, including all associated media, is for general educational and informational purposes only. It does not constitute formal tax, legal, financial, or investment advice. Tax laws, including Section 274 and other provisions of the Internal Revenue Code, are highly complex and subject to change. Tax laws, including Section 280A, Section 162, and other provisions of the Internal Revenue Code, are highly complex and subject to change. Transmission of this information does not create a CPA, client, attorney-client, or advisory relationship between the listener and Physician Tax Solutions, or Provident CPAs, PLC. Before implementing any strategies discussed on this show, always consult with your own qualified, licensed tax professional or legal counsel to evaluate your unique financial situation.